every Monday to Friday. This is Peter Lewis's Money Talk. Money Talk.
Good morning and welcome to the middle of the week. This is Peter Lewis with the latest business news from across Asia in Money Talk. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In the headlines for Wednesday, the 21st of February, China's panel banks surprised markets Tuesday with a larger than expected cut to a benchmark rate used for pricing mortgage loans. The People's Bank of China kept the one-year loan prime rate unchanged at 3.45%, but surprisingly cut the 5-year LPR by 25 basis points to 3.95%. It was the first time the 5-year rate was cut since May 2023, and the 25 basis point cut was also the largest cut to the 5-year LPR on record. Hong Kong's seasonally adjusted unemployment rate was 2.9% in the 3 months ending January, remaining unchanged for the fourth consecutive period. The number of unemployed people dropped by 3,100 from a month earlier to an almost 5-year low of 102,600, while employment decreased by 9,800 to 3.697 million. Meanwhile, the youth unemployment rate, measuring job seekers between 20 to 29 years old, edged down to 5.6% from 5.7% previously. Australia on Tuesday outlined a decade-long plan to double its fleet of major warships and boost defence spending by an additional $7 billion to counter China's military build-up in the Pacific region. The investment will give Australia its largest navy since the Second World War, and the plan would see Australia increase its defence spending to 2.4% of GDP, above the 2% target set by its NATO allies. Singapore Airlines delivered its biggest quarterly profit on record as demand for flights kept airfares elevated. Net profit totaled around $550 million in the first quarter of its fiscal year that started in April, and revenues rose to $4.48 Singapore billion from $3.93 billion a year earlier. The demand for air travel remains healthy, the carrier said in a statement, adding that forward sales continue to be robust. In today's programme, I'm joined by Enzio von Pfeil, capital preservation specialist at Financial Shield, and Hong Kong-based macro strategist Patrick Bennett. And with a view from Japan is Tokyo-based journalist and author William Pesek. And don't forget how to get in touch. You can post questions or comments on the Money Talk website at peterlewismoneytalk.substack.com or on Facebook. Peter Lewis Money Talk is the page, and on X at Money Talk R3.
Peter Lewis's Money Talk.
On Wall Street, US stocks were dragged lower by Nvidia. At the start of a holiday-shortened week, the S&P 500 slipped 0.6% to end at 4,976. Losses in the Dow were limited by a 3.2% rally in Walmart following robust fourth quarter results. The 30 stock index dipped 64 points or 0.2%, settling at 38,564. The Nasdaq Composite fell 0.9% to 15,631 amid a sell-off in tech shares. Ahead of its earnings later today, Nvidia shares were down 4.4%. Advanced Micro Devices and Applied Materials also shed about 5% each. US Treasury yields fell ahead of the Fed's January meeting minutes, which are due out later today, and also after soft Canadian CPI data eased global inflationary concerns. The interest rate-sensitive 2-year yield fell 3 basis points to 4.61%. The 10-year yield slipped 1 basis point to 4.28%. The US dollar index weakened 0.2% on Tuesday to hit the lowest level in about 2 weeks. The yen was little changed, around 150 yen to the dollar. China's state-owned banks stepped in to sell dollars on Tuesday in their bid to stem the slide in the yuan following a cut to the country's key 5-year loan prime rate. The yuan was trading at around 7.19 against the dollar in Shanghai, 0.1% stronger on the day. And one other currency to note in Asia, the Malaysian ringgit, extended declines to its lowest level since the Asian financial crisis, prompting Malaysia's central bank to say it doesn't reflect the improving outlook for the economy. The local currency briefly slipped past 4.8 against the dollar on Tuesday. That's its weakest level in 26 years since it reached an all-time low of 4.88.5 in 1998. Gold closed 0.3% higher at $2,023 an ounce. Brent crude oil dropped 1.2% to $82.34 a barrel. Equities in Hong Kong and China recovered from early losses on Tuesday as investors assess China's efforts to stimulate its property market by cutting its benchmark reference rate for mortgages. Mainland China's CSI 300 opened lower, but it recovered from losses of 0.7% in the final hour of trading, with help from the so-called national team to close 0.2% higher. Hong Kong stocks also recovered from early losses to close higher. The Hang Seng Index approached its best level in 6 weeks, climbing 92 points or 0.6% to 16,248. And it does look like the Hang Seng is going to open slightly lower this morning. Futures markets pointing to a decline of about 0.1%, with the index projected to open around 16,225. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our Wednesday morning guest. We have with us our regular commentator on a Wednesday, Enzio von Pfeil, Capital Preservation Specialist at Financial Shield. Morning to you, Enzio.
Good morning, Peter.
And also joining us, Hong Kong-based macro strategist Patrick Bennett. Welcome back, Patrick.
Yes, good morning, Peter.
China's panel banks surprised markets Tuesday with a larger than expected cut to a benchmark rate which is used for pricing mortgage loans. The People's Bank of China kept the one-year loan prime rate unchanged at 3.45%, but it surprisingly cut the 5-year LPR by 25 basis points to 3.95%. It was the first time the 5-year rate has been cut since May last year, and the 25 basis point cut is also the largest cut to the 5-year LPR on record. So, Enzio, clearly the PBOC concerned about the property market, but what sort of impact will this have?
I think very limited, Peter, because it just seems as if they're trying to apply a cyclical band-aid to a structural problem called party-state capitalism. There's a little way that a cyclical rate cut can boost the market for the simple reason that the property market itself, as we all know, is deeply sort of in shtuck, and also the slimming of the bank margins are not exactly going to make the banks sort of keen to keep on lending if they keep on finding their margins squeezed by virtue of diktat. So I don't think this is going to be very effective. If the government really wants to boost growth, which is its decision, of course, not ours, then it has to decide how to do that. But applying a cyclical band-aid to a structural problem, it's a bit like sort of trying to use Scotch tape on a Teflon band on a Teflon pot.
It seems, doesn't it, that people on the mainland are not particularly interested in buying property at the moment. So saying to them you can have a cheaper mortgage is probably not going to change their minds on that.
Precisely, and that's all because of the income insecurity which has been arising for some months now. I again believe because the whole focus has shifted very much to an intensification of the state party capitalism, whereby the party will dictate what companies are to do, and so the free market idea that we have in the West has gone pretty much out the window.
And it seems from what we're hearing from Beijing that the Chinese government wants to be more involved in the property market itself. It wants the states to more control now the provision of housing and for people on the mainland, rather than the markets doing it and private property developers. What do you think of that?
Well, again, because of my education under von Hayek, I just cannot fathom how this is going to boost growth. It goes into this thing that we'll discuss later about this obsession with hitting numerical targets. 5 is a magic number, but nobody really worries about the composition of that 5. Mm-hmm. And so I just don't see growth picking up on the basis of this approach to boosting growth by boosting supply.
Patrick, what do you make of this? Is the PBOC sort of trying a shock and awe tactic here? Because it certainly was a surprise, wasn't it, in terms of the cut to the 5-year rate?
Yeah. You look, it certainly was a surprise in terms of the magnitude, but I'm certainly on the same page here with as Enzio. This is a band-aid and one which will come off in the first shower. Yeah. Look, it's not about it's not about the price of money. It's about the demand for money, and the demand is just not there. So you could cut the price to whatever you might like to, but that's not going to boost the sector. We've seen for some months now, I think it's more than 12 months now, we've seen actually mortgage demand has been slowing. We saw early last year, mortgage holders actually repaying their mortgages because they'd lost confidence in the sector. And that's only been intensified over the last few months. So, no, unfortunately, I don't see this as being any aid. And the further negative kicker to it has already been mentioned. It impacts on banks' margins. So it's while it seems to be a move in the right direction, I don't see any merit in it at this point.
What would it take then to change people's views on the sector and to want to get back in and start buying property again?
Well, yeah, it's got to be like a wholesale restructuring of the sector.
Yes,
we're starting to see. Well, we're with the very, very early stages of that, with large developers, being allowed or will be allowed to fail. We've got it's a long process ahead of us to see that happen. The state wanting to take a greater share of it. We're really regressing. And some of the good work that has been done over the last 10 to 20 years is being unwound. So I have quite a pessimistic outlook that this restructuring, which is necessary, will take some extended period.
So if this doesn't work, what do the PBOC do next? Do they cut rates further? Do they cut the RRR? Is there any more room for the PBOC to ease policy further after this?
Yeah, look, I think there is room to ease policy further, and ultimately you get to a price level which will become attractive, and that's not now. The RRR can be cut further. That will put more stress on the banking sector because we've already got the lower margins and banks being encouraged or instructed to lend more. The issue is the price of the asset, and the asset is overvalued.
So, Enzio, what are your thoughts then about overall the Chinese economy? We're starting a new sort of year. Premier Li Qiang was urging officials at the beginning of the week to work on boosting confidence and to make a priority of trying to boost confidence on the mainland. What can they do? We've got the two sessions coming up, haven't we, at the beginning of March? What should we be looking out for?
Well, not at the Chubby Hearts campaign that we've had in Hong Kong, which is not dissimilar in the sense of let's all have a feel-good factor, and then surprise, surprise, Merlin comes into the stage and decides to wave the magic wand and off we go. That can't work. I really think that unless the companies are allowed to create employment where they see the demand for employment, as opposed to being told where to create employment because the government has decided in its wisdom this is where employment needs to be created. Until that whole mindset switches, I'm afraid it's going to become like Japan. It's just going to go and sink into a hole for some years. And I don't see that changing. William Pesek wrote a very good book on Japanization and the challenges the bank-centered financial system, maturing economy, bad demographics, deflating bubble has created a mountain of bad loans. All of these things that also Gillian Tett pointed out in the Financial Times a couple of weeks ago, they're coming home to roost in China. But it's the basic mindset. They can cut rates as much as they want, but if people don't feel secure about their jobs, and they're not going to go out and spend. It's as simple as that, whether they're Chinese or German or indeed even Kiwis.
But it sounds like you're going to be disappointed, Enzio, because it seems that the government believes that the solution to what's going wrong is not less state intervention, but more state intervention.
Yes.
They're believing the problem is there just simply isn't enough state control over the economy, and they need to take greater control over that and over things like the property market, and in terms of the state really providing property for people rather than the private market.
Yeah, and I'm not going to disagree with what the state wants. That's not for me. That's not my place. I can only, as an economist, point out, as I suspect also Patrick is doing, that these are the consequences of pursuing that supply-driven policy. We did in the Reagan years have the old adage that supply creates demand, but in this case, it's not creating demand because the supply is being not dictated by the market, but indeed by individuals sitting in government cubbyholes, conjuring up dream views of the Chubby Hearts campaign, what might happen if they do this. And of course, that's not going to happen.
Patrick, do you worry about this? Is this something that's also on your radar screen, that simply, the government is just trying to have too much state control over the economy and over trying to create demand?
Yeah, look, certainly it's a concern. I can sympathise, if that's the correct word, with their efforts. When the private sector is failing as it is now, it is incumbent on the public sector to step in. But to step in to backstop it at what level is the question we come to, and I believe it's going to be at a much slower growth rate than these overly ambitious targets. I think the other section to it, at least in the next 6 to 12 and perhaps 18 months, is the state of external demand, is the state of global demand as it affects Chinese activity. We know that that global demand is being impacted by tight and remaining tight monetary policy. That's one of the key focuses of markets at the moment. So that's another headwind that China has to deal with. And the outlook then is certainly for softer and slower growth. Yes, perhaps with more state intervention, which is only going to make the eventual recovery, perhaps in 1 to 2 years or more, that much harder.
And this is going to be an issue, isn't it, for trading partners overseas, that China's overcapacity in areas like electric vehicles, in batteries, in solar panels, that overcapacity, that supply is going to get dumped onto world markets. And we've already had the US saying this week that they're not going to allow that to happen.
Yeah, look, absolutely. Those concerns are very real. The concerns about if you are an exporter to China of raw industrial commodities or of anything, then that your demand, the demand situation in China is going to be challenged. Just as China's external demand will be softened as well. So, some of this is a result of policies in China that have been operating for some time. Others of this, on the demand side, are the result of policies of global central banks, which also have been developing for some time. Right back to the early, or post the GFC and the profligate expansion of monetary policy, and now only the very belated reining in of that is affecting global demand and global activity more widely.
Are you encouraged at all about domestic demand from the fact that at least travel and tourism picked up over the Chinese New Year holiday? Is that a promising sign going forward, or is that rather just something specific to this particular time of year?
Look, I think it can only be. I think it's encouraging, but I think it can only be pent up demand.
Yes.
And I think we've seen that. We've seen that elsewhere as well. People have not been able to travel, for upwards of 2, sometimes nearly 3 years. So I think pent up demand has a lot to, or has the greatest degree of impact here. And if things are to stay the same, and I believe they are, and perhaps get worse, then I do not see those sort of numbers being repeated.
What about you, Enzio?
Peter, if I could just add, we see this in Hong Kong with a lot of mainland tourists coming into Hong Kong, but really to window shop. They eat at McDonald's, they eat at the Chinese fast food places. That's hardly a boost to our economy. They're not really spending in the sense of the lavish doling out of money. And so I think it's exactly what Peter says. It's pent-up demand, but very much on the cheap track. And I think that's so tourism numbers, again, the number itself isn't really good enough. It's what's behind the number.
So the volume of trips has increased, but the value maybe hasn't, because people are spending less.
Absolutely.
They're going on budget trips and being careful what they spend.
Yes. And again, it goes back to this whole theme of income insecurity. And that's, until that goes away, consumption, which is 75% of any economy, is just not going to take off.
And another piece of data that we had out earlier this week is that China reported its smallest annual foreign direct investment since the 1990s. Foreign companies pulling their money out of the economy in favour of opportunities elsewhere. China's direct investment liabilities, that also includes business earnings which are retained in the country, and also investments into the country's capital markets, rose by just $33 billion in 2023. I mean, that presumably is a worry as well, isn't it? That not only is domestic demand not improving, but also sort of foreign investment is tumbling.
Well, it's the flip side of the same coin. Oh, I'm sorry, Peter. Yeah, Patrick, go ahead.
Yeah, look, it certainly is a concern. It's a concern if you look at the currency. There's, those tenets of support for the currency that we had previously. One was FDI, one was portfolio inflow, another being a tool to ameliorate the impacts of inflation. All of those things are gone. So pressure on the currency, I think, is bound to follow. These results now. I would just add, the final one, as I continue to harp on about, higher global interest rates are also, suppressing FDI. But again, the picture that we continue to build up regarding China is one which is, is just not encouraging.
Enzio?
I just wanted to add to what Patrick is saying, that from a different angle, that when I was doing my doctorate on direct investments, my surprising conclusion was that companies go abroad and invest directly abroad, not as an export base, as a cheap export base. That's the newspaper story, but really to sell more into the local market in China. Mercedes selling more cars, surprise, surprise, or Volkswagen or whatever. And it's so the slack in foreign direct investment has more to do with this whole downfall of Chinese domestic demand back to the retail sales, back to the private consumption, than it does with any of the export markets, which play a role, of course, for people going to China. But that's not really where the action's at. It's more fulfilling domestic demand, which is waning.
So to get domestic demand going again in what is rather a moribund economy, what do we need to see from the two sessions, if there is indeed anything that the two sessions can do? Because there are some question marks over whether this gathering really has any power to decide anything these days. But what would you like to see to try and get demand back on track and to get the economy moving again?
My view would be that the whole mindset needs to change. You can still have your party state capitalism. In other words, the party cells have always been in Chinese companies. That's not new. Just like German unions have always been on the boards of German companies, which is not bad in itself. It's the degree of interference as opposed to just being an observer on the board and seeing what's going on. That's, I think, where the rub comes in. And I think until this activated party state capitalism is toned down and the leadership decides that it's really time for the market to continue dictating where it wants to create jobs because of demand, then I think you're going to find the place going nowhere in a hurry. It will Japanize.
Patrick, what are your thoughts?
Yeah, look, exactly the same thing, or very, very similar. That until China has made a decision, a decision some time ago to be involved in the global economy. External demand has been important. If you want to shut that down, then go back to a closed off society, closed off economy, then that's not good for anyone. So given that that's going to continue, yes, the state influence has to be tapered. Has to taper off. More free market, allowing, as Enzio mentioned earlier, allowing companies to employ in areas, in sectors that they wish to. The problem with that, of course, is the cost. In the initial years of doing that. So, we're either faced with low and slow growth for a long time, or we're faced with a deeper slump than we're seeing now before an eventual recovery. So, neither of those paths look to be look to be very attractive. And I hold fears for the outlook for the economy, certainly in the next 1 to 2 years.
In that case, presumably you have some fears for the markets as well, because people had been hoping that we were going to see a bit of a catch-up rally in Shanghai and Shenzhen when the markets reopened this week. Hasn't really been the case, has it? I mean, it wasn't that long ago, whereas if you had a 25 basis point rate cut, Chinese shares would have sort of rallied to the moon. But that isn't the case right now, is it? Patrick?
No, absolutely not. Absolutely not. There was a time, absolutely, any rate cut in China was cheered, from Australia to the Eurozone.
Yes.
That's just not happening now, and that's appropriate that it's not happening. So, I think markets entered the year with an expectation or a hope that China would recover. That's not happening. Markets entered the year and continue to be of the opinion that rates will be cut sooner rather than later. I have serious doubts about that. I think we will hear about that tonight from the FOMC. So, unfortunately or otherwise, the outlook for markets, I think, is quite fragile at what are some markets very extended levels.
But we've got no shortage of stabilisation measures, have we, in place at the moment? So we're hearing of, the authorities stopping hedge funds from selling stock. We're talking hearing about bailout funds. None of this seems to be really having much of a difference, or certainly not really convincing investors to get back into the market.
It's again because they're trying to apply a cyclical band-aid to a structural problem, as Patrick was saying quite visually, that the band-aid comes off in the shower.
Patrick, these stabilisation measures, what do you make of them?
Yeah, again, the band-aids, it's not going to, they're not going to sustain. It's not going to sustain the market in the long term. I think at one level it just identifies to investors that perhaps were not so aware that things are in some sort of strife. I think I'm a free market sponsor of the free market, and I think we're not seeing that at the moment.
And it certainly doesn't seem to be enough to tempt foreign investors who have been bailing out to come back into the markets.
Well, there are enough other places to go also. It's not just China isn't the only pretty girl on the block.
Well, you've got Japan now, haven't you? And India, both doing pretty well. Japan, India,
Mexico, maybe Brazil, maybe Argentina. I mean, and especially in this interconnected world with the internet, heaven help me, it's a different race. And so the whole game of competition is a very, very visceral one these days. It's not just sort of, it's not just believe me because I'm going to hype the story up and issue some chubby balloons and then say, let's all smile and it's all going to be wonderful. That doesn't work anymore.
Let me ask you both about the US, because there's two big events coming up later today in the US that could have an impact on markets. First of all, we get the minutes of the last FOMC meeting, which will hopefully give us some sort of idea about the FOMC's thoughts on rate cuts. And then also we've got Nvidia's earnings, which could possibly be the most important out of the current fourth quarter results season to tell us how the AI trend is going. Patrick, your thoughts first on the FOMC. What should we be looking out for there?
I think we should not be looking out for too much insight on when rates are going to be cut. I think the market is still well ahead of itself when it comes to that. Look at nominal GDP levels. Still very high, still much higher than are associated with interest rates, with term interest rates where they are now. To me, we still have a situation of too much money chasing too few things. So that is inflation. I think rates are going to staying high for a considerable period, and I think the market may unfortunately be once again disappointed when they read the FOMC's words that they are not ready to be cutting rates yet.
Enzio?
I totally agree. The core inflation at 3.9% is just about double the Fed's desired inflation rate of 2%. So I never, and I'm sure Patrick didn't bought, nor probably you, Peter, this whole idea that we're going to have 5 rate cuts this year. I think people were just getting a little bit ahead of themselves, frankly.
What do you make of Larry Summers' comments that it's not inconceivable that rates could actually go up in the next move? He's not putting a high probability on it. He was saying maybe about 15%, but he said, there is still a possibility that rates could be going up.
I think it just alerts to the possibility that the market is underpricing at the moment, and that is something like that is needed I believe to bring the market back into better balance. Not the fact that they're going to go up, but the fact that there should be more than zero consideration that they're not going to.
I mean, if you look at the data, it seems to be showing right now that sort of inflation is rather sticky around the 3% level, and it makes it rather difficult for the Fed to be cutting rates at all at the moment, doesn't it?
Yeah, look, it's just not possible at this level. The Fed is not about to be cutting rates. Growth is strong. Inflation is still too uncomfortably high. We're still in a tightening phase.
Enzio?
I also would add to that to sort of mess it up a little bit that the U.S. corporate bosses are losing optimism, according to The Economist of the 10th of March of this year. They're seeing consumers running out of steam because the excess savings accrued by shoppers during the pandemic have now been whittled away. The Chinese consumer health warning, we discussed that before a little bit, this income insecurity in China. And finally, America's manufacturing boom is slowing. It has actually halved in the second half of last year. Real monthly factory construction, the rate stood at 8% a year versus 17% for the first half of the year. So there you have a slowing economy. You may have a tinge of stagflation indeed come through.
And Patrick, let me ask you about Nvidia. It's obviously the bellwether stock, isn't it, for the AI boom that's been really driving markets sort of higher. So this could be the most important out of all the stocks that have been reporting in the fourth quarter. But obviously, great expectations from it.
Yeah, look, great expectations, and we've seen some profit taking ahead of the result, which is not surprising. I think this is a long-term sector that people want to be invested in. If we do see some disappointment to expectations, it will be only because those expectations are quite ambitious. So, the long or the medium or long-term prospects are good. Short-term volatility may it may suffer from short-term volatility as does everything else.
And when we look at how the markets are going in the US, we've had a 5-week rally that's now sort of run out of steam. Last week, stocks were down for the first time in 5 weeks. Do you get a sense, Patrick, that the market might be running out of steam here?
Well, I think it should be. I think to the degree that some of the rally has been based in expectation for cuts. It should be facing headwinds. On the other hand, growth has remained firm. I think there needs to be some rebalancing or some rationalization here. I think there are still good stocks out there. I think the U.S. economy is still performing okay. Notwithstanding that it's come off its peak, but to expect that we push on to higher and higher highs from here, I think takes a leap of faith that I don't have in me at this stage.
I wonder, Enzio, just how much the US is an outlier, both in terms of the economy and the markets, because we're seeing other countries around the world sink into recession, aren't we? Japan's in a technical recession, the UK's in a recession, Germany's in a recession. Although in Japan's case, it's not stopping the markets heading towards sort of all-time highs. Is the US maybe an outlier here in the strength of the economy there?
I think it is, and I think it is for a very difficult reason for us economists trained in traditional economics, because I think that the internet and this whole AI stuff is really changing the equations quite considerably in terms of how one has to think about these things. And I'm certainly work in progress when it comes to thinking about how this new economy actually operates. It isn't quite just the old paradigms that we've been growing used to, that all demand is demand, all inflation is demand driven. I mean, so you can't just attack inflation from a demand side. We all know that, but I'm just saying one way to obfuscate things, it's the AI's influence, which is still very, very nascent. But I think we have to all kind of revisit the toolbox and just make sure that we are actually in tune. That speaks just as much for me as for others, perhaps other colleagues, that we're kind of keeping in line with this change in the economic paradigms that are happening in front of our eyes.
Patrick, let me just finalise by asking you quickly about Japan. I mean, Japan's economy has slipped into recession, but nevertheless, the stock market there getting very close to that 1989 high again. I'm sure we're going to get there, aren't we?
Look, it certainly feels like it. I think we will. I think the currency remains weak against a strong dollar. Obviously, translation of Japanese companies' offshore products back to Japan makes those numbers look better. Buying into the Japanese market, through the weaker yen has also been enhanced. So yeah, I think we will. But yeah, amazing to think we're getting back to the 1989 highs. It's taken quite a while.
I remember that was the time when I moved out to Japan for the first time. Okay, great to hear your thoughts. Thank you both very much. You heard there Patrick Bennett, Hong Kong-based macro strategist, and also Enzio von Pfeil, who is capital preservation specialist at Financial Shield.
Money Talk.
I'm joined now by Tokyo-based journalist and author William Pesek. Morning, William.
Good morning, Peter.
Well, the main headlines in Japan seems to be the economy in recession, but the Japanese market's virtually back at all-time highs. That all-time high hit on the final day of trading in 1989. It certainly looks like Japan's back in a bull market, doesn't it?
Yeah, but it's kind of a split screen for the ages, as you suggest, right? I mean, the stock market is going gangbusters. The economy is flatlining to some extent. The political system here, the prime minister's premiership, is in a bit of disarray, but investors are very, very bullish on Japan. It's fascinating.
Is it helping him at all, the prime minister, the fact that the market is almost back at an all-time high?
I think it might actually do the opposite, because I think one of the problems that Prime Minister Kishida has had is that I think many Japanese have come to realize in the last year that inflation is rising a bit faster than wages. And Japanese are seeing headlines of the Nikkei going gangbusters, and they're looking around saying, hey, what about the rest of us? We're not enjoying this prosperity. So in some ways, it actually might backfire on him. And, usually in the U.S., you talk about this kind of positive wealth effect. When the Dow Jones or the S&P 500 are rallying, a lot of American households think about their 401ks and their retirement accounts, and they think, well, that's good for me eventually. But I do think that in many ways, Japanese are looking at the stock market surging. They're looking at their own wages over the last, say, 10 years. And they're wondering when it might filter into their lives in a positive way. And I think they're still waiting for that. So it's interesting.
We've got the next round of wage negotiations coming up, aren't we? Presumably the Bank of Japan is hoping upon hope that we get a decent round this year.
Indeed. But you do read more and more about how a lot of companies are looking at the state of the economy. They're looking at the fact that Japan entered the year in recession. And in many ways, will that in some ways damage confidence in corporate Japan to raise wages at this point? And that's a bit of an open question. I think one of the problems that Japan is having with regard to these wage negotiations is that it's great to have a raise this year, but what about next year? And I think in terms of changing consumer behavior that's been in a kind of deflationary funk for a long time, if you don't have confidence your wages are going to be increasing next year and the year after, will you change your consumption habits in the ways that Japan's economy needs? And that is a bit of an open question. I think that Japan really is kind of, it's creating a riddle for the history books at the moment. And economists are trying to get their head around what these latest Shunto wage negotiations might mean for Japan and whether or not they'll go the way that investors had hoped. I certainly hope so. The Japanese do need a raise at this point.
Does it feel like a recession over there? Because although the data says, technically it is a recession, when you look at things like the employment market, that seems pretty robust. The unemployment rate's just 2.4%, an 11-month low. The tanker and services are showing, strong business conditions across pretty well all industries, really. Does it feel like a recession?
It does not. It does not. But, I think in many ways in the post-COVID world here in Japan, it's been harder to get a kind of intuitive sense walking around the city, walking around Tokyo in terms of what's going on. I think that, if you go out to restaurants, bars, entertainment districts like Shibuya, Ginza, those areas, I'm not sure that the entertainment sector's ever fully recovered from COVID in many ways. And, young Japanese we keep reading about don't go out the way that, middle-aged Japanese do. And so it's hard to get a feel for that for the most part. But I don't sense recession. No, I certainly don't.
So what is the Bank of Japan to do? Has it missed its opportunity to raise interest rates? It's rather hard to do it, isn't it, when the data says you're in recession?
I mean, yes, I think the BOJ lost its window. I think that the last 6 months of last year would have been a perfect opportunity for the BOJ to, if not step away from QE officially, to at least telegraph a kind of blueprint and a timeline for doing so. Now, you have the situation where, the economy is in recession. China is slowing, and I think that's affecting BOJ's psyche in a very big way. I think that the Bank of Japan is looking at their, Japan's biggest trading partner and saying things don't necessarily look so copacetic on that front. And you also have the political situation where the prime minister's approval ratings are, 17%. And sure, you'd argue the BOJ is independent and they shouldn't care about that, but this is Japan. And so I do think the BOJ has missed its window. So every morning when I wake up and I read commentary about the BOJ will be raising interest rates by June, I kind of roll my eyes a bit. I mean, maybe I'm wrong about this, but I don't see that as being possible. If you think that Governor Ueda is going to suddenly develop, a confidence gene that we haven't seen thus far, maybe we'll see.
There is an argument that says that if the Bank of Japan were to raise rates, it would actually help the economy because banks would then, be more willing to lend at higher rates, and presumably, consumers get a bit of a windfall as well from higher rates. Do you think that's true?
I think it's true, and I think also there's a psychological aspect here too. If you are a Japanese, CEO, or you are an international investor investing in the Nikkei, and you're thinking that Japan is ready to move to the next level, Japan is ready to race forward, Japan is back, as you said in the intro to this conversation. If the BOJ doesn't have the confidence, never mind to raise interest rates, just a step away from, keeping training wheels on the economy. If the BOJ doesn't see fit to do so, why should investors and CEOs have confidence? And so I do think that the BOJ taking a deep breath, taking a plunge and saying, look, we're ready to live without the life support of QE, I think that would have a positive psychological effect. I really do.
Because at the end of the day, rates are still going to be very, very low, aren't they? Even if the Bank of Japan does raise interest rates, they'll probably be around zero.
Exactly. And the fact that, more than 90% of Japanese government bonds are held domestically, and they're held by every major institution from banks to endowments to pension funds to companies. Basically, there's this mutually assured destruction dynamic where nobody here wants rates to rise. Nobody wants yields to surge. And so the idea that the BOJ, even raising rates a little bit, would suddenly send yields surging to 2 to 3% is a bit of a reach. And so I do think that it would be a confidence boosting effort, exercise, if you will, for the BOJ to pull off a rate hike or two, as long as they telegraph it in advance, and as long as it seems like an orderly and rational response, not a kind of knee-jerk reaction to something. I really do think from a psychological standpoint, the BOJ normalizing rates would have a positive impact.
And what would that do for the markets? Ironically, the markets, I mean, Japan must be the only country in the world at the moment where it's in recession. The central bank's about to raise rates and the markets are at all-time highs, pretty close to.
Yeah. The split screen, right? I mean, I think, one thing I wonder about, if you are Governor Ueda, and the last thing any Japanese CEO or any BOJ governor wants to be blamed for is causing the next recession, right? Or ruining a company or ruining the economy. And, might Governor Ueda be looking at the stock market rising and saying, do I really want to be the guy to take steps to send the market sharply lower? But I do think that we need someone to be an adult in the room. And the BOJ's job is, we learned from the Federal Reserve years ago, is to pull away the punch bowl before the party really gets going. And at some point, investors are going to look down and they're going to say the road below us is not really there. And so they'll start selling the Nikkei because they realize that optimism on the market has outpaced economic fundamentals. And so I do think, again, if the BOJ telegraph steps to normalize monetary policy, to wrap up QE, and to talk about raising rates by by sort of the middle of the year, it would have a negative effect on the market. But in the long run, I think that everything would even out.
So if we compare now the Japanese market almost very close to being back at an all-time high with 1989 when it was last at these levels, are there similarities between the two dates, and what are the differences as well between the markets now and then?
Well, I mean, one of the dissimilar situations, if you will, is that the banking system in Japan is currently stable. And you can argue the banking system here is actually reasonably healthy, unlike in the late 1980s. Basically, if the BOJ began raising interest rates the way it did in the late 80s, early 90s, the banking system is not sitting on basically $1 trillion of unrealized losses. And so in some ways, the financial sector is a lot healthier to move forward. I think the Japanese population is ready for normalization. I mean, I think in many ways they are ready for the BOJ to take a step in the right direction. I think also Japan is realizing that the weak yen, 20 years of weak yen policies have kind of backfired, right? Because in many ways, if you're a company, if you're a government official, why take risks to upgrade, to recalibrate economic engines when the BOJ has your back with free money left and right? So I think the differences between now and the late 1980s are pretty significant.
And also the Japanese stock market's actually cheaper now, although it's at an all-time high or close to an all-time high than it was back in 1989. It was actually very expensive then, in fact, wasn't it, when you looked at the PE ratios and compare them to now?
It is. And a lot of Japanese companies are cash rich. I mean, that's why Warren Buffett is here nibbling around. And I think one of the other things we have to look at where Japan is concerned right now is Japan has a bit of a safe haven halo at the moment. When you look at the global economy, when you look at what's happening in China, when you look at what's happening in Europe, when you look at what's happening in the US in terms of, well, let's face it, political instability at this moment, Japan is a very, very hospitable, quiet place. Mm-hmm. And I think Japan is benefiting from this safe haven bid, if you will. And that's something that I don't see going away in 2024.
So basically, it's benefiting from not being China. And for those investors who want Asia ex-China, Japan is the place to be.
And also not having a Donald Trump about to trying to retake power. Yeah. So I think that's a positive. And I think investors really are looking at Japan. They're saying, for all of its fleas, for all of its problems, Japan is the sort of least ugly major market in the world at the moment. And I think for valid reasons. I mean, we can talk about the demographics and how in the long run, those are forces that investors should be worried about. But if you're thinking about 2024, 2025, you're looking at the global economy and the shocks to come. Japan does look like a reasonably, warm bath, if you will.
Okay, well, we'll see if it gets there very soon. I suspect it will in the next few days, but let's see. Thank you very much indeed, William. That's Tokyo-based journalist and author William Pesek.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll be back tomorrow when I'll be joined on the show by Andrew Ferris, the CEO of Econosis Advisory, and Nick Marrow, lead for global trade at the Economist Intelligence Unit. With a view from Taiwan is Ross Feingold, Director of Research at Cyrus Consulting in Taipei. See you tomorrow.
Money Talk